Hey, Chad Peterman here, your host of the Can't Stop the Growth podcast, a show that advances the home service industry and beyond. For today's episode, I'm about to pass the mic to our partner, Chris Moore, for his special monthly series on all things risk management. Together, we bring content that empowers you to build a positive, healthy workplace for you, your people, and your bottom line. So let me officially pass the mic to Chris Moore for today's episode, chock full of insights that you can take and apply to your growth. Now listen and grow.
Hello everyone, I'm Chris Moore, a managing principal at Epic Insurance Brokers, and I'll be your host of Risky Business, Understand Your Risk, Realize Your Reward. None of us, in our personal lives or in business, get to enjoy a free ride to our end goal. Risk travels with us for the entire ride. In this series, we're going to discuss risk and the strategies we can use to eliminate and mitigate the impacts risk can have on our way to reaching our goals. Along the way, you'll hear compelling stories, effective strategies, and real-life experiences that empower and educate you. Let's get started. Welcome to the first episode of Risky Business. Understand your risk, realize your reward. Over the last 15 years, I have had the opportunity to have thousands of conversations with hundreds of business owners. Believe it or not, the most meaningful conversations did not take place when I spent 90% of the meeting spouting off insurance jargon. They didn't happen when I was trying to sell something. The conversations and ultimately the relationships that became the most meaningful came from meetings where the business owner shared their goals and shared their vision for their business. We discussed where the business is today and where they want the business to be. We discussed how they plan on getting from where their business is today and how to get their business to where they want it to be. We discussed who their key people are and their key people that will help them get their business there. We discussed how long they thought it would take to get there. And we discussed what are the things that can mess all of this up. Today, we are going to set the foundation for the series. We are going to talk about risk. We are going to discuss the elements of risk. We will get you thinking about how to take ownership of a risk management process. 181 million. That is the number of people that will purchase one or more Powerball tickets in a given year. That is more than half the population in the entire United States. I found an article on Powerball.com, of course, dated March 26, 2020, that the Powerball's starting jackpot is a $20 million annuity. On August 23rd, 2021, Powerball launched a new Monday night drawing to accompany the existing drawings of Wednesday and Saturday nights. For all of you Powerball purists listening, if the starting jackpot increased since the onset of the Monday evening drawing, I do apologize. But really, if you're anything like me, you aren't going to go out of your way to purchase a $2 Powerball ticket just to win $20 million. But if you happen to see a billboard that is advertising a jackpot of $1 billion, you may purchase a ticket or two to have the chance of cashing in that winning ticket. What is the chance that one of your Powerball tickets wins that jackpot? Well, it's 1 in 292.2 million. Lloyd Christmas said it best in the movie Dumb and Dumber. So you're telling me there's a chance. As we purchase that future winning Powerball ticket, we don't really think about the risk of $2 in the zero-sum game of winning $1 billion jackpot. The reason we don't stew over this choice is because the risk-reward relationship is intact. The loss of $2 is not significant. The reward, undoubtedly, will change your life. Why don't we buy 1,000, 5,000, or $25,000 worth of Powerball tickets? Well, that's because the risk profile just changed. When you chose to start your business, I doubt the words chance and luck were part of the initial business plan. You are in the position you are in now because you believe that you have something that gives you an advantage. You believe that under the right set of circumstances, that you can obtain your desired results and reach your goals. What if those circumstances weren't exactly right? What if they changed? What are some of the curveballs? Well, those things are called risks. Risk, in its simplest definition, is the possibility of loss. In that very definition, there are two very simple words: possibility, a thing that may happen; loss, the fact of no longer having something or someone. When analyzing risk, we want to know how possible something is, and we want to know the maximum loss potential that exists if the something were to occur. Another way of saying it or looking at it, we profile risk in terms of frequency and severity. Let's go back and revisit our Powerball scenario through the lens of a risk profile. At a basic level, we categorize risks into 4 profiles. The first is low frequency, low severity. When the jackpot gets around $1 billion, we buy a ticket or two. Let's say this happens every 5 or 6 months, so 2 times a year. Our improbable gamble is very infrequent, and our $4 to $8 risk to dream a little bit isn't going to create a material loss to us personally. So bottom line, go for it. Go get your winning ticket. Risk lens 2, high frequency, low severity. Let's say that you don't care what the jackpot is. You're cool with a $20 million annuity. You're buying a ticket or two for every drawing. That $4 ticket purchase 3 times a week, well, that ends up being $624 a year. Your ticket purchase is the same amount as the example above, so the risk of $2 to $4 is still pretty immaterial, but you're doing it 3 times a week. Due to the frequency level, your losses are 100 times greater than the example above. Bottom line, is your virtually guaranteed loss of $624 a year materially impacting your life? Is it getting in the way of your financial goals? Maybe it is, maybe it isn't. But you should stop, you should analyze it, and you should evaluate it. Let's look at risk profile number 3, low frequency and high severity. This person is like the person in our first example, the low frequency, low severity guy. But now they're going to swing big. They're going for the $1 billion jackpot. The difference is they aren't buying a ticket or two. They're buying 1,000 tickets. They are rolling into their favorite C-store with $2,000 and laying it on the counter. They aren't texting their friends asking if they want to chip in or pool their money. This person is just ready to roll when that jackpot is ripe. Like the first scenario, This person only does it 2 times a year. The difference is this person does it big. Bottom line, this person's going to lose $4,000 a year. They're going to lose 500 times more money than our first scenario, and they're going to lose about 6 times more money than the person in the second scenario buying small increments of tickets every single week. So we have to ask the same questions here that we did in our second scenario. Are the losses materially impacting your life? Is it preventing you from accomplishing other things? Again, maybe it is, maybe it isn't. But you should analyze and evaluate it. Risk profile number 4: high frequency, high severity. You knew that this person was coming. In this scenario, we have our 3 times per week Powerball player, and he is playing big. He is buying 500 tickets before each and every drawing. The only reason he isn't buying as many tickets as the preceding example is because when I did the math, it got really weird really fast. So he's buying 500 tickets 3 times a week. This person is spending $3,000 a week on Powerball, $156,000 a year. Bottom line, we don't even need to ask the same questions that we did in scenarios 2 and 3. The losses will absolutely have a material impact on this person's life. It will absolutely prevent him from accomplishing other goals. Due to the frequency of the actions and the compounding severity of losses, it's pretty obvious that this behavior should be avoided. All right, let's move away from Powerball for a little bit. That last example made me nauseous. The takeaway: you need to profile risks based on their probability of occurring and the impact of their occurrence, so frequency and severity. Once the risk profile is determined, we can measure the risk relative to the reward. What do we stand to gain from taking on the risk? The reality is, we don't know all the answers, and we don't always have all the information we need at the time we need it to make an informed decision. The good news is, we don't need to have all the information. We don't need to have it all to move forward. We don't need a crystal ball. What you need is a risk management process. The risk management process, it's not implemented by a guy wearing khakis. It is implemented by you. It's implemented by the business leader. The process will include other members of your team and partners from outside your organization as well, but without your buy-in, this process does not happen. So what is a risk management process? At a high level, a risk management process is the continuous process of identifying, analyzing, evaluating, treating, and reviewing risks to mitigate their negative impacts of loss that they can have on your business or in your personal life. So let's look at step 1, identifying risks. In this stage, we're really determining what our risks are. And your business encounters all types of risks. You see operational risks, which are risks that can impact your day-to-day business operations. You see financial risks. These risks include volatility in pricing, economic recessions, credit risks, rising interest rate environments. Your business sees strategic risks. These are the risks that can impact your business's long-term plans. And we have hazard risks. These risks are the unforeseen events that can occur naturally or unnaturally, and they can certainly impact your business's day-to-day operations. They can impact your business's long-term plans. So you need to look at those risks and identify them. Once you've identified the risks, this is when we can start to analyze and evaluate the probability of the risk occurring and the potential of the loss associated with it. This goes back to our 4 risk profiles that describes a risk's level of frequency and the potential of its loss severity. Now that you have identified, analyzed, and evaluated risks, you need to determine how to treat these risks. You have 4 options. Option number 1, you can avoid the risk. Our good buddy that's spending 150 grand a year on Powerball tickets. Perfect example of a risk that should be avoided. But let's go with a non-Powerball example. Risks that should be avoided normally present themselves with high severity loss potential. We see this a lot with strategic risks. Do you make that acquisition? Do you offer a new service to generate an additional revenue source? Do you hire someone at an executive level in your business? You can choose to avoid these risks, or you can go with option 2. Option 2, it's to accept the risk. This is obviously the flip side to avoidance. You accept it. We can't go through life and we can't go through business avoiding any and all risk. At some point, we need to accept the risk. You decide to make that acquisition. You offer a new service that generates an additional revenue source. You hire that new CEO, that CFO, or that COO into your business. Other examples of accepting risk will typically come from the opposite end of the risk profile section. These would be low frequency, low severity risks. These are risks that you really don't spend a ton of time worrying about. If they occur, you simply retain the losses, like a crack in a windshield, you lose some tools, you test out an additional marketing or advertising strategy. If it works, great. If it doesn't, the severity impact is low that you end up retaining that loss and you move on to the next thing. Our third treatment option is to reduce or mitigate the risk. If a risk moves from a low frequency, low severity tag to a high frequency, low severity tag, we need to pause. How did the risk increase in its frequency? What changed? Can we take action to drive down the frequency? For example, small fender benders never used to be a real issue in your business. Now you're seeing them pop up more regularly. Do you have more cars? Do you have new drivers? Are you going to a new part of town? Ultimately, can you determine the root cause? If yes, what can be done to reduce the level of occurrences? Our fourth and final treatment option for the day is to transfer the risk. How can we transfer risk to a third party? The most common way to transfer your risk is to purchase an insurance policy. You pay the premium, the third party accepts the risk. That's how it works. Another way to transfer risk is to do it contractually. You see this all the time. You may have contracts with your customers, your suppliers, even other contractors you work with. Each of those contracts has language that shifts risk from one party to another. In the next couple of episodes, we are going to take a high-level view at risk transfer and how you purchase insurance. We're going to start with the general liability policy. You all have them. What does this policy actually do? How does it work? What are the top exclusions a home service business needs to know about And how do you address those exclusions? Until then, noodle on the ideas that were brought up today. Begin to identify risks that can disrupt your business at the day-to-day level, the financial level, the strategic level. Analyze and evaluate those risks. How likely are they to occur? If they occurred, how severe would their impacts be? Begin to evaluate those risks. Start with the ones that present the most severity to your business. How do you want to treat those risks? Do you want to avoid? Do you want to accept? How can you reduce or mitigate their impact? Or can you transfer that risk to someone else? By taking the above approach, you are on your way to creating a risk management process for your business. Thanks for listening, and we will catch you on the next time of Risky Business. Understand your risk, realize your reward. Thank you.
Thanks for tuning in. If you'd like to get connected, you can find me at chadmpeterman.com. To see what our team's up to, you can visit petermanbros.com. As always, keep growing out there.